Okay, reward to risk analysis. This is the final form of analysis we will perform before entering into a trade. And we will do it before every single trade. Okay, this is where we examine to see if a trade is actually worth taking by looking at the potential reward versus the risk we are taking on. We look for things such as key supply or demand levels upcoming that could hinder our profit targets. How far are we into the price move? Have we hit extensions already? Where's the safe stop for the trade? Okay, no matter how good the fundamental, technical, and sentiment picture is, if we don't have a good reward to risk ratio on the trade, we will not take the trade. Okay, this is very important. For example, let's say we're in an uptrend and we had a 100 pip swing to the upside. We've fallen just short of a potential target extension, and the market's starting to pull back a bit sideways. So we have a corrective pullback, a sideways market, just what we call chopping wood, consolidating. But we're only about 30 to 40 pips away from that extension. Okay, do we want to buy that market? Absolutely not. We just had a 100 pip swing. Okay, we have too much downside risk. We would need to put our stop, and let's just say we pulled back 30 pips. We would need to put our stop 70 pips away to have our stop loss protected behind a key level. Okay, but that only leaves us 30 to 40 pips of potential profit before we hit a strong resistance level. Okay, that is not a good reward to risk ratio. Okay, and you certainly do not want to take those kinds of trades, because if you start to risk more than you can potentially profit, you're in for a very hard road. We'll talk a little bit more about reward to risk ratio a little bit later here in the course. But certainly a rule of thumb that you always want to remember is never risk more than you could potentially profit.